Awesome. Hello everyone. Welcome to another episode with me, Shashank Udupa. I hope you can hear me clearly. I hope we're all live and we're all good. So today we're going to talk about the chemical sector because a lot of people from the audience said they want to understand what are the stocks in the chemical sector, what's happening in the chemical sector. So today we're going to do a massive review of everything, right? Today we're going to talk about what is happening in the chemical sector, why did the chemical sector boom so much. We're going to look at three stocks that have a nice moat in the chemical sector and are supposed to do really well, right? So looking at this, we will make our analysis today and we will look at some financial analysis, we will look at some fundamental analysis, and we will understand whether these chemical stocks are good, and we will understand if the chemical industry is good. Okay, and also the market had actually gone down in the morning, which gave me a mini okay like that, but then it finally went up. So the currently the market is slightly up, so that is great for us. Okay, so let's look at the top three chemical stocks for today, right? And we will look at the entire chemical industry as well. So stay tuned. Very good. Now, we're going to do a proper sector analysis. We're going to see the problem solutions and we're going to see everything, right? One by one. Now, first, I want to understand what is happening with the chemical space. Okay, so for a lot of people who don't know what's happening in the chemical sector, today we're going to do what is going to happen in the chemical space. Now, the first part of the story was earlier everyone entire chemical industry, right, or the so-called specialty chemical industry was rallying in the last 5 to 6 years. It was doing really well, but investors ignored companies that have large exposure to bulk chemicals or commodity chemicals, right? So when people were trying to invest in chemical sector, we were only focusing on the specialty chemical players, not the bulk chemical players over there. So now what has happened in the recent past is because China didn't do well and China is now suffering because of a lot of issues. And China, I'll tell you why China suffering is actually impacting the chemical sector as well. The second part of the story was that bulk chemical company valuations with respect to specialty chemical valuations were having a big difference, right? Whereas the bulk chemicals were 10 times less in earnings as compared to specialty chemicals. So specialty chemicals in the industry was given a slight premium. Now looking at the recent supply disruption that happened in China, global power outages that is happening, coal energy crisis that is also happening, all of this is impacting the chemical sector play. So we will look at it one by one. The third part of the story is that windfall gains are happening because of all of these problems. In the near term, you can see that all of these chemical companies will start doing really well, right? Because of all these problems that are happening with China. And China also has this new thing called dual control policy, which is also, again, dual control policy is something that we will come into slightly more detail. So all of these things are impacting the chemical sector. Now, attractive valuations increased with tailwinds, and a lot of people are investing in capex as well. This is making this segment look slightly interesting. So we will look at some of the other things as well. Now, if you look at some of the initial coverages that a lot of people have done on the chemical sector, what a lot of people are saying that quality Indian chemical businesses can justify current valuations. Why? Because they're doing really well, their execution is awesome, and they know how to do this, and also the macroeconomics are favoring Indian chemical sector, right? So that is why we are looking at quality chemical players will do really well in the near term is what people are predicting. Now, what a lot of other companies in the market who are doing research reports are also picking stocks that are building very good research and development capabilities, and I'll tell you why they're doing R&D a lot, and they're also adhering to global manufacturing standards. So these are the two things that are very important. The third thing is the valuation. Now the valuation is very high currently in the chemical space, right? Now valuation of 31 times to 45 times September 2023 EPS is built in 14 to 18% earnings growth for the next 15 years. So a lot of people in the industry are giving these companies higher valuations because they are assuming that their earnings will grow by 14 to 18% and will continue to do this compounded every year for the next 15 years. This is what they're saying. Now, why are people giving such a high valuation? Because they're saying macroeconomics will provide a strong support to these companies, because if these companies start demonstrating new growth drivers beyond their existing whatever they're making, right? If they're making a certain amount of vertical, if they're catering to this vertical, are they moving and making another vertical? Are they experimenting and are they going into different places, right? So all these things are helping the chemical sector space right now. Now just to give you guys an understanding of the global chemical industry right now, okay, just to give you an understanding, China has 37% market share in the chemical space. 37% chemical space market share is with China. European Union has 17%, United States has 14%, and India has 3.5%. That's it, just 3.5%. That means the scope of India to go obviously take more market share is higher. Now what has happened? China mein problem ho gaya, right? There's a big problem in China. So that is why now the global chemical industry is now expected to grow at 6.2%, but India is expected to grow slightly more. Why? Because India is trying to take over the market share by doing all of the manufacturing in India right now. Now, if you look at the graph on the right hand side, see the commodity or the bulk chemicals or the commodity chemicals takes over majority of the entire industry. Specialty chemicals is now taking little more chunk constantly, and there are others that are taking up small amount. But just understand that China's downfall will lead to India's growth, right? Now, look at some of the important Indian chemical companies that have multiple growth drivers, right? Indian chemical companies that have multiple growth drivers. All this is only for education, guys. So please take as much education as possible. Now, look at this. Some important things I'll show you. Indian customers don't want to completely depend on China's supply. So a lot of Indian companies were taking all these specialty chemicals from China. Now they're saying, I don't want to entirely depend on China. I'm going to take some from India as well. So that is why companies in India are benefiting a lot, right? Now, India's entry into specialized chemical has helped companies like Navin Fluorine and SRF Chemicals, right? So these two companies are also making a good amount of money because of this change. Now, if you look at another thing, right, there's a lot of increase in outsourcing patterns. So companies like Aarti, Navin, SRF, Pi are all benefiting because a lot of companies are now outsourcing the entire chemical part. They don't want to do it in-house. So some of these things are helping the existing companies. Don't worry, I will share this presentation with you guys after this live is over in the description below. You can have a look at it and read when you're free time. Now, the chemical industry of India has a very strong, they're predicting a very strong earning story. They're saying that the earning story in India is long and strong, and they're assuming that even though India has a small market share of 3.5% and the market share is slowly growing, people are saying that even a 15% CAGR in INR terms over the next 15 years would garner an 8% global market share. So this is what people are predicting, that Indian companies are growing fast, so they will take over the market share faster. Okay. The next thing is that beneficiaries of certain macros, which is the macroeconomic model, is actually helping India because there's a lot of built-in capabilities that India has. For example, there's built-in entry barriers on the chemical process, and continuously they're trying to expand into different chemical sectors as well. Indian companies are upgrading their talent. They're also spending a lot of money on R&D, and they're setting up massive infrastructure projects. And if you've seen some of the chemical companies, they are investing heavily into capex. Now, if you look at some of the candidates that would make that would be slightly different, and we'll discuss them later, or some of the candidates that look very good, is one is Aarti, right? Aarti Industry, aggressive import substitution play. Okay, they're also going into aromatics, so Aarti is looking really good. Atul has the best free cash flow generation. Clean Science has disruptive chemical processes. NFIL, which is Navin Fluorine, is diversified fluorination play, again in the monopolistic space. Pi Industries is in the foray, is coming into fine chemicals and pharma, so they also have unique R&D capabilities. Okay, and SRF is basically adding differentiated DNA to build global leadership, so they're trying to go global ASAP. And Vinati is also doing a lot of things. So basically we're just looking at the entire industry for now, then we will look at some good stocks, right? So these are some of the things you should look at. Now, why so much growth? A lot of people are saying, Shashank, why growth? Why do you predict 15% growth, right? That's because China's dual control policy is definitely impacting in the near term. So China's key provinces are being sounded out red alerts and being forced to cut down on electricity consumption. We know that, right? Now, as their operating rates of chemical plants in China decline and more production cuts, shutdowns become more frequent, inventories are likely to decline. And if inventories decline, prices might become haywire, right? Prices might go up because demand is there. But who's going to step in? India might step in to cater to this demand. Obviously, there's US, there's Europe, but India will also step in to cater this demand. Now, if you look at the coal prices, how is coal prices impacting the entire chemical sector? Now, power is a major cost in chloro-alkali industry, right? Now, if you look at the caustic players, caustic soda players, they have actually rallied in the past. Gujarat Alkali and all that, they've all rallied. So the international caustic soda players have been increasing their prices, right? This is also going up. So the domestic manufacturers are therefore likely to benefit on the cost front. So all these are very important because most industries, most Indian companies are using captive power plants, okay, as well as grid power, which largely use coal supplied by Coal India, or use natural gas for power plants. So this is why Indians might benefit slightly a bit from the same scenario. Now, this is a very important chart. Please have a look at this. Okay, this is a very important chart. This is the chemical companies in India stock performance over different time horizons. Now look at the last three columns on the right, right? There's 5-year CAGR, there's 10-year CAGR, and there's 15-year CAGR. Now we want to look at companies that are doing really well in the future, right? Now if you look at the 5, 10, 15-year CAGR, you look at the stocks like Navin Fluorine, SRF, Aarti, Vinati, they're doing really well. Good CAGR in the last 10, 15 years, the good CAGR, right? Then if you go slightly below, there's Deepak Nitrite doing really well. There is Alkyl Amines and Balaji Amines, which are both in the amino sector. Again, very heavily dependent on the raw material prices. And then you look at the last ones, they're all the new companies that have come out. Rosari Biotech is a new company. Galaxy Surfactant has been there for a bit, but all these companies have not given crazy amount of return yet. But these are the companies in this bracket that have given good returns over the last period of time. Even Pi Industries over 15 years has given a very good CAGR. Right, so this is a very important chart. Go through it. It's from Nirmal Bank. Now these two slides I'm going to skip. I'm not going to go into detail, but you can look at it. So basically this is a graph, or this is a table where it talks about all the different chemical companies that are there and what are the new things that they're doing in the future. Very important chart. Okay, this is all the companies that are currently there and what are the new things that they're doing in the future. For example, they're coming out with the chlorotoluene chain 2024 type of opportunity. This is beautiful. Okay, this you need to read. You can go through it one by one. It talks about every company doing every single thing with respect to what the future is and how the industry looks. So I'm going to share this presentation, go through it in detail, right? Now, if you look at the top 20 companies, they've delivered basically 19 to 24% CAGR for EBITDA which to PAT, and also they've given a good ROCE of 17%. Now, I'm talking about the top 20 companies are these. Now, if you look at the top 20 companies with respect to market cap, right? SRF is number 1, Pi is number 2, Deepak number 3, Aarti number 4, Atul number 5, Alkyl and Navin. It goes in this order, right? You can see the revenue here. You can see the EBITDA percentages here. Let's see, Deepak Nitrite has a very high EBITDA percentage for some reason, which is a CAGR growth because they're a fast growing company. If you look at the ROCE here, look at the ROCE, Alkyl Amines has 40%, looks quite interesting. And if you look at the revenue here, obviously Pi Industries has so much revenue, which is for 4,592 crores in 2016. And now it has come up to 8,200 crores. It's almost doubled in the last 5 years, right? So this is what you need to look at as well from making your understanding or making your assumption on how the chemical companies are performing from 2016 to 2021, and will they perform in the future is the big question. Now, will they perform in the future? You have to look at this. Okay, will they perform in the future? You have to look at this chart. So look at this chart and then look at this table and try to match what might work well, what might not work well. So these are the 2-3 things that we look at. Got it? Again, this is a massive understanding into the chemical space. So for all the people who don't understand chemical space, this presentation is very important for you guys. Now, what is happening? There's a long runway and there's a sharp run up in valuations. Now, chase scalability, not valuations. Why do we keep saying don't chase valuations? And a lot of people are asking, is this undervalued? Is this overvalued? I don't take so much consideration into valuation, right? The reason why I don't take so much consideration into valuation is because, boss, we are playing the long game, right? Jo bhi hota hai, abhi next 5 years we are playing that. We don't want to look at something right now and saying it's overvalued or undervalued. Yes, in the near term, if you're doing a short term buying and selling, valuations are very important. But if I am looking at a 5-year perspective and if the growth is continues to be the similar way, if there's a 15% growth, whatever you invest right now, it will be undervalued compared to the next 5 years, right? So if you look at the growth, look at scalability. Can this scale up, increase their revenue and take global market share? Don't look at valuations, look at how can they scale up. Now, if you look at how they can scale up, there is import substitution that is helping Aarti and Atul. There is growth of outsourcing. A lot of people are outsourcing. That's helping Pi, SRF and Navin Fluorine. And there's also niche applications that are coming out with companies like Clean Science and Vinati. So all these small things, start looking at who's going to be better, who's going to be really good in the next few years. Now, the first stock that we will look at that has also corrected a lot is Deepak Nitrite. Now, if you look at Deepak Nitrite today, let's do a quick analysis of Deepak Nitrite. It's fallen by 3.49%. It's actually on a downward trend. If you look at the last 1 month returns, it's 2.21%. But if you look at it from the fall of October 19th, jab market girna start hua, it's gone down by around 17.7%. So this is something that's gone down quite drastically. And if you look at their max chart, every quarter, every years, they've been giving consistent returns, right? Even if you ignore the COVID years, all throughout from September 2010 to May 2007, they have given significant amount of return. So if you just calculate from here to here, right, just till here, they've given 1500% returns in the last 10 years. So very good, consistently giving you returns, consistent compounders. If you look at their financials as well, if you look at the yearly financials, right, we need to see if it's growing, right? The revenues is growing, top line is growing. Yes, top line is growing well. EBITDA is also growing, their EPS is also growing, and their net income is also growing. So everything looks from a very good angle. They're also doing a lot of capex, is what I've heard of. I keep looking at their investor presentations. I keep talking about their what do you call that? I keep looking at their con calls, investor con calls, and if you look at their long-term debt is around 534 crores. Not a bad, not that bad, because they have good amount of assets as well, right? And if you look at their total stock reserves is 1,800 crores, so they have enough reserves and surplus to pay off their debt. So this is the first company that we are going to look at. Yeah. Now, if you look at Deepak Nitrite, what do? They're leading producer in something known as phenolics. Phenolics is giving a lot of returns for them right now. They're also there into other things like IPA, phenolics, studolines, cumidines, but phenolics department is giving them a massive amount of returns, or massive returns from that particular segment. Okay. Then if you look at their engineering plants, they have 6 manufacturing plants right now. 6 manufacturing plants is basically they have it in different regions. It's all mentioned there. So basically, why Deepak Nitrite is so good is because one, their capex, the way they do their capex, which is basically they make their manufacturing plant, use it for proper production. The management team of this company is extremely smart, extremely smart. They're also amongst the top 20, they're also amongst the Fortune next 500. So they're planning that this will be the next Fortune 500 company, because their capabilities are super strong. The management is insane, right? They also do a lot of R&D, and they know exactly when to shift, right? Whenever they see there's a massive growth in one segment, they predict it and they build capabilities for it and they attack it. So that is something that Deepak Nitrite does really well. Now, if you look at this, right? If you look at what they actually do, they have 4 departments here. They have basic chemicals, fine and specialty. They have performance products, and they have phenolics. Now, if you look at phenolics, 58% of the revenue contribution comes from the phenolics department, right? 58% of the revenue comes from your 53% contribution to earnings before interest and tax comes from phenolics department itself. Now, if you look at the other things that they have, performance products is only 6%, basic chems is only 17, and the fine chemicals is only 17. Phenolics is very important, and they're also doing more capex to expand their phenolics plant as well. So they're trying to increase their phenolics plant also. And this is important. Who is their clients? Okay, look at this. All the big companies are their clients right now. All the major companies are the clients of Deepak Nitrite. Having a strong client base is very important for growth. And if you look at it, there are a lot of other chemical companies in this space that are also doing this, right? So very, very, very strong on this perspective. Their client base is extremely tight. Now, there's something known as Warren Buffett valuation model from his book Buffettology. So this is something that we check from our perspective as well. So what this basically says is it assumes that the EPS growth and the DPS growth keeps continuing. Looking at the historical EPS growth, they're predicting the future EPS growth. And after predicting the future EPS growth, it comes to a conclusion that they are planning to grow, or Deepak Nitrite will continue to grow at a 15% projected annual return using current EPS growth visibility model. So 15% growth is very good. But if their sales go up, then they'll give more than 15% growth. But 15% growth is not bad at all, because you'll start compounding on the same angle. So that is very important. Now, if you look at the good and the bad things, we need to look at everything, right? Good, they're very strong with what they do. They have massive experience. Their management team is very strong. They have strong supply chain. They know exactly how to do manufacturing capabilities, so they're very strong. Their weaknesses is the raw material price. If the raw material price goes up, chemical industry starts getting little scared, right? So raw materials cost going up will create a massive problem for Deepak Nitrite. Sustainable energy sources, if it goes down like what's happening right now, that will also create a small impact. And now anything that happens with foreign exchange, like if you do a lot of exports and the foreign exchange dollar price goes down, this will actually impact the Deepak Nitrite as well. So all of these things are very, very important when you look at it. Have a look at it in your free time. I will share this for you guys as well. The number 2 stock, which is slightly lower, okay, number 2 stock is called Navin Fluorine. Now let me show you Navin Fluorine here, okay. This is slightly in this in the small cap, mid cap space. So it's in the mid cap space at 16,000 crores. Oh, it's actually gone up a lot. It's in the 16,000 crore space. If you look at the last 5-year chart, right? Apart from this year and this year, it's given consistent returns over a period of time. So even if you had invested 5 years ago, and if you ignore the COVID boom if you ignore this COVID boom until here, right, it has given 176% in the last 4 years, 4.5 years. So it's not bad. It's not bad. Assuming COVID boom on the COVID, though, it's only going up, right? And look at this, there's multiple drops. So this was a COVID drop, then it went up, then we saw another drop here, right, and then it went up. Now we're witnessing another drop here, but then eventually it'll go up. So don't worry, everything goes up over time. So all the people who are panicking that it fell 4 days in a row, because it went 5 days in a row, so now it's going down 4 days in a row. So it's completely all right. Don't worry about it. The revenues, if you look at the revenues, right, let's look at the revenues. It's a good consistent growth, except for this 1 year where there was barely any growth. But then here the growths have kicked in. Again, the entire industry of chemical space works a lot on capex, which is putting more manufacturing plants. If you look at the EBITDA growth, is consistently going well. Net income growth is also there, except there's a degrowth from last year to this year. So this is something that should be investigated. And the EPS growth has also gone slightly down. So either which way, the reason why I'm saying Navin Fluorine is very interesting and it's a good stock to look at, we will talk about that. So Navin Fluorine makes fluorine gas, right? Navin Fluorine, basically, if you look at the details, pricing pressure in the international market has actually negatively impacted this business mainly, and the decline in revenues has been witnessed in this quarter in the CRAMS department or the CRAMS segment. CRAMS is basically contract research and manufacturing segment, right? Because there was one large order worth 5 crores from June to July, and then they delayed that execution. So the massive order of 5 crores, they actually delayed that execution. Now the management commentary on high value business remains very upbeat. Okay, so they're saying we're getting a lot of new projects, they're getting new product launches, they're adding more clients, they're getting more repeat orders, and they're increasing their market share. So this is something that's looking very good. And NFIL, which is Navin Fluorine, has also added a few mid-sized biopharma clients in the contract research manufacturing. They're also doing something known as deep bottlenecking of the CRAMS facility, which will give them 20% more added capacity, and this will be completed in the next 6 months. More capacity means more revenue generation, means more top line, means more midline, maybe more bottom line, maybe more EPS growth. That's all. These things are very important when you look at Navin Fluorine. Again, so why are people bullish on CRAMS? A lot of people in this space are bullish on CRAMS and CDMO, right? Or CDMO is also the same thing, contract development and research manufacturing. So basically, after clocking $100 million in revenue, Asian CROs and CDMOs have clocked a CAGR of 35% CAGR growth consistently, which is massive. And people are predicting that this will go to 40% CAGR growth in the next few years. And we expect Navin Fluorine to also do something very similar, where they will clock $100 million in revenue by FY25, considering the opportunity in the market right now for CRAMS is very big. So everything is going in this company's way, and it can be a very good multi-bagger looking at it from a futuristic perspective. Multi-bagger means at least more than 1x, 2x, right? Now, if you look at the problems that they're facing right now, again, material cost is creating a problem. New employees to hire, because it's slightly skilled labor. You need to have technical knowledge of being in the chemical space. So this is actually creating an issue for them. Increased employee cost is also creating issue. And now there's also increased pricing pressure from international markets. So they're operating at low margins right now. So if all of this gets solved, then they'll make massive revenue. Either way, it's a good thing to look at from a futuristic perspective. Now, NFIL is basically uniquely placed compared to its contract manufacturers, okay, given all of this innovations. Right now, it's also present in multiple verticals, not just in one vertical. Number one, they have a new R&D facility set up in UK that's providing access to international pharmaceutical companies. After the acquisition of Evosys, the company has a larger market share and is now able to win multi-million-dollar contracts, end-to-end transformation deals. So all of these small things are happening, and fluorination is basically a complex and growing chemistry industry, right? It's a growing industry in the chemical space, but it's also very, very, very complex. So this is something that you need to look at. If it's complex, then the entry barrier will be high. Not many people can come into this. So you can look at this from that segment. Now, if you look at the new business details that they're coming up, if you look at them, their capex required is 434 crores capex. Right, they've entered into a $410 million contract with a global company manufacturer for high performance product in the fluorochemical space. So they're doing a lot of capex from that angle. They're investing 365 crores for a dedicated manufacturing plant, which will again become very big, and a captive power plant, which will also help them manufacture more. So, and the main thing here is they will manufacture both intermediate and final products. So this is very important. So if you look at that, Navin Fluorine is poised to do really well in the future. Now, what are the key business risks? Again, what is the risk? We also have to look at the good things, and we are smart, so we look at the bad things, because fundamental analysis is not only looking at good things, but also looking at bad things. So if you look at the bad things, Key man risk. Remember, I spoke about key man risk once. Basically, the current MD, Radesh Welling, has brought new momentum and all that. But key man risk is that one guy is driving this entire business. So if he exits or something happens to him, it can create a lot of problem for Naveen Fluorine. Raw material risk, which is basically there throughout every chemical industry player. That is what is happening with raw material risk. Product and customer concentration, because the risk that they have a lot of, so basically they have a bigger risk because slightly NFL has given its smaller companies are not smaller clients are not doing really well, but their bigger clients are really there, and if they lose any big client, it will decrease their revenue quite drastically. Also, there's increased competition that's coming up. There's dependency a lot on fluorine. They're not making new verticals, and there's also delay in capex that we saw recently that led to the delay in their projects as well. So if they overcome all these risks, then it'll be interesting for them, okay, to go ahead. And if you look at it from the Buffettology valuation, they're projected to grow at a 6.98% annual growth rate, okay, which is not very interesting, but because they're in this unique monopolistic moat segment, it looks interesting for me. Right, so that is why I am looking at it from my angle. The third company that recently came out, which you guys all know, is Clean Science. Okay, giving a quick brief of Clean Science, and we did a proper deep dive into Clean Science as well. Now, if you look at Clean Science, when it came out of its IPO recently, has given 28% since the IPO. It's in the mid cap space of 21,000 crores. Right, the P ratio is quite high again, but I don't look at valuations at this point because everything looks stupid right now. Every valuation looks big. So we're not going to look at that. And if you look at the total revenue is growing, yes, total revenue is growing. They're inching towards 1,000 crores they're inching towards $100 million in revenue. Their net profit is also growing consistently. So this looks like a consistent compounder, which can become a consistent compounder in the future. So that is what we basically look at. So if you look at Clean Science, basically they manufacture critical specialty chemicals such as performance chemicals. And if you look at the performance chemicals as MEHQ, BHA and AP. I'm a finance guy, not a chemical guy, so I don't know what they actually do, but they're into the performance chemical space, right? Now, key customers are very strong. They include SRF, Bayer AG, Genex and Vinati Organics. So these are some key clients that they have. And if you look at some of their products, Tatva Chintan's key products are used as reagents in the synthesis of zeolite. So Tatva Chintan's products are critical in manufacturing zeolite as well. So to give you a more introduction into what Clean Science do, we'll talk about this, right? Now, Clean Science is basically waiting for better entry points. So they're trying to expand their product basket. It is never good to stay in one product basket. So they're trying to expand their product basket by a certain amount of time. So their certain basket right now is only performance chemical. They should enter into other different type of chemical segment as well. Right now, in its capacity in existing products by 50%, they're trying to grow also. Now, if you look at their unconventional play, they're in a very niche segment, right? They're in a very small segment. Their ROCE is at 74%, which is extremely high. They have very good FCF cash generation. FCF is free cash flow. Then a lot of money is coming into their pockets, right? So they're very good from that, but they've not expanded into different regions. That is something that they need to do right now. They have a competitive advantage. Why? Because the management team is good. They also have a de-risked business model. So they're only focusing a lot on a special niche that they have, and they're doing really well in that particular niche. And if you look at their benefits, they have cost advantages. They have better product yields and they use cheaper and easily available raw materials. So these are some things that help them. Now, this is very important. If you look at the product portfolio, right? If you look at the product portfolio, the first product, which is MEHQ, BHA, AP, which is basically in the performance chemical space, is giving a lot of revenue, right? If you look at the revenue growth, it was 1465 in 2018 or 146 crores in 2018, has gone up to 354 crores in 2021. So this has done a tremendous growth. And if you look at the other ones, which is pharmaceutical chemicals, has also given 49 crores to 83 crores, double growth. If you look at the last segment, which is FMCG chemicals, 33 crores to 63 crores. So all of them have grown by 100%, right? So it is insane what they're doing. That's why their revenue is looking good. They're playing at a current premium right now. Their ROC is quite strong. Their free cash flow is strong. And if you look at their geography, it is well mixed with China at 37%, India at 31%. They're quite well mixed, right? But majority of the revenue currently comes from performance chemical, which is 70% of the revenue comes from that. They do have a slight distinction between their products. And this is what is written there. I'm not going to go deep into it. Some of them are slightly basic, some of them are slightly good. So again, it's a very strong team with good manufacturing capabilities, and they know exactly how to do it, and they're very cost effective. So this is one of the few distinguishes that Clean Science has. Again, this is Debjani Mukherjee who actually helped me do this presentation. So a shout out to Debjani for creating such a beautiful presentation to make everyone understand the chemical space. And guys, just a disclaimer in the end that this is only for educational purposes. This is not a stock recommendation. So I will share this presentation with you so that you can go home and read it whenever you're free, right? Also, guys, just to give you guys another perspective, a lot of people were worried. A lot of people were worried because the market was going down. I would say do not get worried if the market is going down. The market keeps going up and then has to correct and go down, then eventually it will go up. If you are invested in fundamentally strong stocks, then you do not have to worry about it from a long-term angle. So just stay invested, don't take too much tension. A lot of people are asking me about what about SRF, what about UPL, what about PI. PI is very good. SRF is a market leader, so they are also good. We are looking at stocks that are that can do really well in the future. And the reason why I've said these three stocks are undervalued right now, they're currently not undervalued because obviously the valuations of everything is going up. But I look at everything from a futuristic perspective. So if you ask me, Deepak Nitrite, is it undervalued right now with respect to 5 years into the future? I'll be like 100% yes, right? Because this is going to grow very well, because revenues will grow. Maybe 1 year will do bad, but remaining 4-5 years will do well because they're in this unique position of a monopolistic zone, and the competition is really less. So this is why I love the chemical space. I'm very bullish on the chemical space right now, especially when China went down. I'm very, very, very bullish on the chemical space. So chemical space is something that I'm enjoying right now. The market is falling. I'm averaging it even lower. As and when I get capital, I keep deploying it so that I keep averaging it lower, right? So keep looking at these things. Do your own research, and I hope you guys enjoyed this episode. I try to come here and teach as much as possible in the most simplistic of manner so that people with no idea of the chemical space can understand the chemical space. So again, guys, if you like this, please click on the like button, subscribe if you are if you're a new user, and I'll keep coming up with more episodes like this. Again, this is me, Shashank Udupa, signing off. Thank you from my side and thank you from my team for giving me your time. Okay, see you guys, take care, bye.